We do have a guest that's been standing by watching what we have been seeing live. Joining us now is Jeffrey Cleveland, who is the principal and chief economist over at Payden Rygel. Good to have you back on, Jeff. Let's dive right in, as Fed Chair Jerome Powell has really commented on a range of scenarios that we've been trudging through here as the coronavirus pandemic. We seek to have the vaccine rollout kind of subside some of the biggest impact that's had on the economy. Fed Chair Jerome Powell and the broader FOMC putting in place policy in many different forms, and even today they have continued to issue that in their statement they're going to continue to be accommodative as necessary. What do you take away from the presser and then the question and answer section of that we just heard from as well?
Yeah, so I think the big tension here is that the market and also the Fed expect better growth in 2021, a lower unemployment rate in 2021, higher inflation in 2021. And then I think the reporters and the market in some sense is saying, okay, that should mean a change in monetary policy. Shouldn't you start talking about tapering or start thinking about hiking rates? And the message that the Fed chair wants to convey is that no. The outlook has improved, but we, the Fed, want to see actual economic data come in that's great, through the course of the year. We want to see the unemployment rate fall. We want to see full employment. And then once we see the actual positive outcome, we can talk about changing policy. We're not going to change policy based on a forecasted outcome. I think that's the key sort of tug of war that's going on here in the press conference, but also in the market at this moment.
We heard Fed Chair Jerome Powell talk about an unequal economic return for some workers versus others, and really looking at the data as we had seen for the most recent monthlies that came through, even in the unemployment rate for people of color, Black Americans, versus the broader national average. It is still well above, and looking at the data, you would still be able to see that some ethnic groups are still in their own recession right now as others are making their way back into the workforce. What are some of the tools that the Fed could even employ to ensure that there is a more equitable return to work?
Well, the Fed has limited options here. I mean, they have interest rate policy at zero. They're doing their forward guidance, which is pledging not to change that until probably 2024. So that's what they can do, I think, most directly. Also, asset purchases, to the extent that has an impact on longer-term interest rates, that could affect the economy. But monetary policy, I have to tell you, is a very blunt instrument. So it's probably not the best solution in real time. I guess the best thing they could do is not mess anything up. So not tighten prematurely, which would set off a chain reaction in financial markets and tighten credit conditions too much, and then that would have an adverse impact. But they're very determined not to do that here. So I think that's the message that they're sending, is there's no intent to tighten policy anytime soon. That should be a good tailwind for the economy.
Yeah, it seemed to be the concern coming into today's announcement, right, is that the Fed would take a tapering type of policy and implement that a little bit earlier than expected, and the taper tantrum was something that we heard from. I want to break that down into two questions for those who may be asking you, who you advise, and even for the average person out there, how we're thinking about a taper tantrum, what that would look like, and if the Fed does begin to taper a little bit earlier than expected, even though they've laid out this kind of 2 to 3 year outlook, what exactly would that look like, and how would you best define that?
Yeah, so first, what is a taper tantrum? You have to go back to 2013 when the Fed was conducting asset purchases. Fed chair at the time, Ben Bernanke, June of 2013 came out and just uttered the word taper. The reaction from the bond market was key and surprised a lot of people. The bond market said, oh, wow, the Fed is tapering. That means the Fed will be hiking sooner than we previously thought. So the bond market started to price in rate hikes sooner. That sent Treasury yields dramatically higher in a short period of time. Stocks took a dive, the dollar strengthened, everything like that. That's the taper tantrum.
Right.
So is that what we're seeing this year play out? No, absolutely not, Brad. I mean, what we're seeing play out is the Fed chair is still saying at this press conference, we're not even talking about tapering. That is not a topic of conversation until we see the data improve substantially. Right. So they're trying their best to push back and not repeat that 2013 episode.
Jeff, I wanted to ask a two-part question, but unfortunately we're pressing up against the end of the hour. We got to leave things there for the day. Always a pleasure to get your time and insights. Jeffrey Cleveland, who is the principal and chief economist over at Payden Rygel, joining us here today on Cheddar.